Welcome back, everybody, to the Informed Homebuyer Podcast. I'm Rich Curtis, your host. I've got my co-host, not my ho-host, my co-host, Dave Miller, here again. Thanks, Dave, for coming.
Thanks, Rich. Thanks for having me. Looking forward to it.
All right, today we're talking about a topic that I think many of you are interested in, and I think there's actually a lot of confusion in the marketplace around this. We're talking about down payment assistance programs, and we're going to cover everything from soup to nuts, going from your own kind of down payment assistance, getting money from family, getting money from your own assets that you didn't think you might be able to access, all the way to assistance programs where you get some free money, some where you have to pay it back, some where you don't have to pay it back. We're going to cover the whole gamut here so you have an idea of where you can go to get some assistance. If you've been saving up, you've been thinking about buying a home and you're close, maybe you got your 3% for your closing costs, but you don't have that plus your down payment, and you're thinking, I just don't want to wait another year, 2, 3 years while home prices are appreciating right now, especially where we are in California. They just keep going up. Here are some ways you might be able to access some down payment assistance and pull the trigger a little sooner. Now, what I will say is a caveat from the top here: the programs we're going to cover today are going to cover, like Dave and I were talking before we got on here, about 95% roughly of the overall buyer pool. There are niche programs at little credit unions all over the place. If you're a third generation one-legged farmer from Iowa, there might be a special down payment assistance program for you that Dave and I don't know about. We can't keep track of all of those little niche in-house like credit union products. These are the bread and butter all day long, available to most people, and what most of our clients are accessing for down payment assistance programs that we're going to go over today. If you have an exceptional niche case, reach out to Dave personally, and he can go through that with you and help you kind of source that. But today we're going to dive right into the main ways that most buyers are going to access it. Starting with Dave, what if family wants to give us some money? How do we work that?
Yeah, Rich, you bring up a good point. And when we're talking to folks that are interested in buying a home, I never assume anything. I ask a lot of questions that might be favorable to the buyer. And those questions, and I get a variety of answers. And, so if you're looking to buy a home, and to the scenario you pointed out, Rich, where maybe you saved your 3% for closing costs and or down payment, but you're just don't have enough money, or you're close. I always ask questions in terms of, okay, how much money do you have? Where's that money at? And what access to money do you have? Do you have grandparents or parents or, siblings or family members that can gift you some money? Do you have a 401k that you can tap into? And this doesn't have to be an all or nothing thing. This could be, a small percentage of what you need. But, I've asked people, do you have a family member, that can gift you some money? And I've gotten answers like, no. I mean, who's got that kind of money laying around? So you just never know.
Yeah. And then we have had other people whose family kick in like multiple six figures. You never know.
Yeah, and we've kind of joked about that over, on occasions, Rich. Like you and I bought a house at one point in time, and we didn't have a 20%, down payment handed to us, and and I don't disagree. I think it's great if people have access to that. I think it's amazing.
We just never know. Some families have the resources to do that, and we might as well start there because it's the lowest hanging fruit.
That is correct. And I think the delay for most people buying a home, there's always a few things. You get established in your job, you're starting to make some money. You feel like you can make a payment in your comfort range or your price point range, but you have not saved enough money for down payment and or closing costs. And it takes a while sometimes. We talk about an average purchase price if we use 500,000, for example. And, we're looking at a conventional loan, and maybe you need at least 3% down. There's 15,000, then another 3% for closing costs. There's another 15,000. You're looking at $30,000. Well,
yeah, and that's a good point. We kind of assume everybody's listened to every one of our podcasts, because you absolutely should. We're great. You should have listened to every single one. But why wouldn't you have?
Yeah.
But if you haven't, just a quick recap, your closing costs, you can ballpark those here in California at about 3% of the purchase price. That's where Dave's getting that 15,000. We have a whole podcast that goes through all that for you. I'll link to it at the end. You can get a refresher. We won't go through it all here. And, if you're not a VA buyer, your minimum down payment is about a 3% conventional, 3.5% FHA. So that's where he's coming up with that other 15,000 for that 30,000 total for your kind of minimum purchase money out of pocket if you're not a VA buyer. Then that reminds me, actually, I think we should kind of go over VA a little bit in terms of, because that is kind of down payment assistance by allowing zero down, but we'll get to that later. So
Yep.
when it comes to gift money, Dave,
Yep.
are there any restrictions? What are the restrictions? How much can somebody give me? Do they have to be a direct family member? Could my buddy just give me money? I don't have any buddies giving me, a bunch of cash,
Right.
but are there
Yeah.
restrictions on that, upper limits, lower limits, who can do it? And what's the documentation we need
Okay.
to make those gift funds good?
Great question. It's really designated to be a family member, and I've seen close friends and family members give gift funds, and there needs to be an accompanied gift letter. And there's a standard gift letter that your lender, if I'm your lender, I provide the gift letter for both you, the buyer, and the gifter to sign. And it just explains the nature of the relationship, um, how much they're gifting, what property address it's being gifted for, and has the money been transferred yet or not. It's a pretty basic letter. It's not something that, you know, you have to spend a lot of time. It's, your name, your address, the name and address of the gifter, and a signature from each person. And that's really it for us. Sometimes, in some cases, we need to document the gifter's ability to gift. And
Like a
that would
proof of
be,
funds or something?
yeah, proof of funds. We state, maybe they're the funds, what bank it's coming from. So if it's coming from, just say Bank of America, for example, um, there's based on the program, we may ask for just like page one of the statement that says, hey, here's my mother-in-law or my dad's bank statement that shows they have enough money to gift me this money. And what they're doing is they're trying to avoid people like me and you sliding some money to the folks to
Oh,
buy the
right. I didn't
home.
think about that. Right. Yeah,
Yeah.
yeah. They want to make sure it's coming from a legitimate family member.
Yep.
Now,
Yeah.
baked into this too is this has to be actually a gift. Because if this was a loan, that affects your debt to income ratio, which again we
Yep.
cover in other podcasts, but that affects the whole thing. So the gifter is saying, I am giving them this money with no expectation of repayment, correct?
Yes. That's a very good point. That gift letter says there is no expectation for repayment.
Okay.
And I will say, if what people decide to do, if down the road and you made a bunch of money on your house and you want to, it was paid forward and you want to, like, we don't police it once it's gifted and it's done, but we follow specific guidelines, and that needs to be the expectation going in, is that you're not required to pay that money back. That would affect your qualifying ratios. And you cannot
Gotcha. And
borrow that money either. So it's got to be a gift. Yeah.
and then is there any limits on how much gift fund someone can give you?
No, there's really
Great.
not. I mean, you could gift, whatever you have available and you've worked out with that family member, more power to you if you can get more. Um, and I've seen it all across, like we said, just a few bucks. And it doesn't have to be, if you're just doing 3 or 3.5% down or 5%, it doesn't have to be all of it. You could have some of your money and maybe you're short a few bucks. And someone's willing to gift you a few $1,000. I've seen every scenario. So,
Oh yeah, we
um,
we had a single mom that literally she was real tight on everything, and she needed $5,000 and got that
yeah,
from a family member. It wasn't a huge ask. It wasn't 15 grand. It wasn't 30 grand. She just
yeah.
needed that extra 5,000 to be able to get over the finish line, and a family member was able to come through for her.
Yeah, and sometimes you don't know unless you ask, right? Like, and I've had those
Yeah,
conversations where people, "Oh, I never really thought about that." Well, let me reach out to some folks and see if they're, wanting to help out a little bit.
yeah.
Um,
And now, in terms, we're going to talk about another strategy in a moment, seller credits. But we have limitations on credits that we can get from sellers
yes.
when gift funds are involved. Does it affect any, credit maximum limitations or anything about total skin in the game in terms of money from or is it just off on the side? It doesn't affect any of those other ways we negotiate.
Yeah, that's correct. There used to be limitations with gift funds, and you
Mm,
used to have a certain amount of your own monies contributing towards the down payment, but that's kind of changed now. So there's really no, cap limitation on the amount of gift funds.
perfect.
So again, we will ask, do you have the ability for gift funds? Do you have the ability to, tap other resources such as a 401k? Maybe you have assets in a retirement program, and there's a lot of plan providers will address this for you. So if you have a 401k or some type of qualified retirement program that's not like STRS or PERS, you can access oftentimes some of those monies for a down, for the purchase of a home. Um, and
Yeah.
sometimes you could borrow money against your own 401k and pay it back. It used to be that we used to have to count that against your ratios, but not anymore. So if you were to borrow monies against a retirement program that you're paying yourself back plus the interest to yourself, we don't count that debt against you as a lender.
Which is great. So you can actually take a loan against your own retirement, but refill that money so you haven't permanently lessened your retirement, and it doesn't count against your debt to income or your ratios for your overall qualification. So that is actually a pathway for borrowing additional sums that don't count against your ratios, which is a really, really good point and a great option for a lot of our people who are W-2 employees with a 401k.
Right. And so, when we talk about gift funds and we talk about down payment, we use that kind of the 3% scenario. With first time home buyers, for the most part, you minimum down is going to be either 3% conventional, like you mentioned, 3.5 FHA. And we do have some down payment assistance programs that would allow for either down payment or closing cost or both, that I'm prepared to talk through as well.
Oh yeah. And before we jump into those,
Yep.
let's talk about seller credit. So one
Yes.
thing that happens is someone might have saved up a portion of the money. They might have gotten to that 3% mark and they come to us and they haven't been watching every episode of the podcast, and they
Yep.
don't know that in addition to the 3% for your down payment, you actually need your 3% for your closing cost too. And then they're really crestfallen and, I've been saving all this time and I can't do it. One potential, and it depends on market forces and where you are and sellers and the price of the property. There's a lot of caveats to this, but we can pursue a seller credit to closing costs. So if you've saved up your 3% and you were planning on using that for your down payment or for your closing costs, but you don't have the other, we get you a 3% credit from the sellers that covers your closing costs, and you can use the money you've saved as your down payment. It's not necessarily down payment assistance, but it does cover half of what you need in terms of cash to close to get into a property. Now, if you're in a rapidly appreciating market or a strong seller's market like we've had the last few years, harder to get a credit. If you're in a multiple offer situation, harder to get a credit. But if you're in a neutral or a normal market, or especially in a buyer's market where you are, then it's oftentimes not that big of a lift to get some sort of seller credit. We usually have about a 3% max, except VA allows up to 4%.
Yeah, and FHA will go up to 6%. So
FHA will go to 6.
yeah.
I didn't know they went quite that. That's amazing. Yeah.
Yeah. And, but I think you bring up a really good point, Rich, when it comes to seller credit, availability of seller credit, what the maxes are. And again, just like the gift funds, is the seller credit can be $1,000. It could be a small percentage there. It doesn't have to be all or nothing. And it could be just enough to get you over the finish line. And I think, Rich, as someone that, before you go out and you start driving around and showing people property, you typically will have a conversation with me if I'm the lender and say, hey, have you pre-approved these guys? And I'll say, yes, they're short a few bucks. And that doesn't mean necessarily that the seller is going to eat the seller credit if you think the value's right. So point being is, hey, Rich, can you maybe offer $2,000 over the purchase price, or $3,000? Will it appraise at that? And then, so the seller nets the same. So if the seller was offering, listed a house for 500,000, you bring your buyers in, we're going to give you, 504 with a $4,000 seller credit towards buyer's closing costs. As long as we feel like it will appraise at the 504, everybody kind of wins in that scenario.
Yeah. And if your head's swimming with the kind of complexity of that strategy, I get it. That's what we're here for. That one is one that, like I say, in a rapidly appreciating, market where the appraisers aren't catching up to the market value because homes are going up so fast, we have trouble with that one because we're already pushing appraised value just by nature of what people are willing to pay. So like that strategy in a 2021 where people are just being bananas and paying ridiculous money for houses, in the COVID market doesn't work. But in a market like right now, where we're back to more normality and people are getting appraisals and we have, prices that are ticking up at a normal level. Yeah. The price someone lists a home at, it's not, I think some people have a conception that there's one price that this house is worth, and it's not that sort of thing. It's a lot more nuanced than that. It's really worth what you're willing to pay and what they're willing to accept. And the comparable properties, we're making a lot of calculations here. We're looking at a similar house that had a swimming pool and taken off the swimming pool, or another house that had solar and taken off the solar. And so it's not one number, it's a range of numbers. So what Dave's saying is if the seller's asking for a number that's not at the tip top of the range, you have a little bit of room there to slap on an extra couple of thousand. It'll still be within the range and get a credit back for that money. Do be advised when you do that, you are financing your closing costs in that way.
Yep,
So that
is
is
correct.
adding to your loan amount, and you are paying interest on that amount. Just so we're transparent about that. When it's a pure credit to offset your closing costs, you're not financing those in. When you overwrite and get credit back, you are now financing them in. These are all just nuanced ways for you and different ways to skin the cat for you to be able to get the money you need to make it happen. And the right one for you isn't an answer we can give you on the podcast. This isn't, patent financial advice to you guys. This is, here's a bunch of ideas, a bunch of ways we do it. Now get on the phone with us. If you're in our market, we'd love to have your business and your phone call. And if you're not in our market, call your trusted professional and go down the rabbit hole and investigate all these options and figure out which one's going to be the most advantageous for you. And we have a few more for you, so don't bounce out just yet. All right, Dave, do you want to dive now into the actual assistance programs where they're getting some credit for the down payments?
Yeah, let's talk through that. And so, when you're saving these funds for your down payment and or your closing costs, and there's a couple scenarios here. So, one of the things, and we used 30,000. So, on a $500,000 purchase, 3% for down payment if you're going conventional, 3% for closing costs. Well, if you've just saved 30,000, there's your whole nest egg, right? That's your down payment. Does that leave you any reserves? My guess is, so there's been plenty of times where folks have saved, close to that or even more than that. They have enough for 3% down plus closing costs and a few bucks. And I may advise, hey, let's go with this down payment assistance program. And that will leave you with that potentially 3% in the bank. So, now you have a $15,000 buffer based on our scenario. So paint, carpet, reserves, you're not tapping all your funds. And that doesn't really cost you much. So one of the programs I was going to talk through with down payment assistance is it's called MyHome from Cal HFA. And that allows you to borrow up to 3.5% for FHA or up to 3% for conventional in terms of down payment. And that's at a 1% interest rate that is deferred until you sell or refinance your home. So basically it's, if you were conventional, 3% down, 15,000, you're only paying 1% on that. That you don't pay anything on that until you sell or refinance. So it's such a nominal cost to you as a home buyer. And can really speed up the timeline where it takes for you to have the ability to buy sooner than later.
That's like the old school silent second that you've borrowed that. So we'll call it the 15 grand in our scenario. You've borrowed 15 grand additional on the property, but it's sitting there only accruing interest at a rate of 1%, and it doesn't change your actual payment. It's not, you're not making a payment on that portion of what you've been loaned. Is that correct?
That is correct. And
awesome.
so it's just a great program. Now there are some limitations with this, and most folks that are, like use the 95% of the people that, fall within these parameters, there's income limitations. And for our, for where we work, Rich, primarily Sacramento County, El Dorado County, that's 225,000 income. Well, most folks are, if you're using some type of down payment assistance, you probably fall underneath that, that income limit. So,
and that's the limit also for a married couple. That's combined for married and correct. Same for single.
Yep.
Or is there a lower limit for single?
Nope. Same 225 is just the income limit for the buyers or all folks that would be on the loan that would be qualifying. So, but you bring up a good point. Like, maybe you make 350,000 and you're married and we're going conventional, and only putting one of you on the loan, then, and your income sub 225, we can still qualify you for the program.
Nice.
Yeah. And so, that's rare. We rarely kind of run into that. But again, these types of programs, and again, we talked about, you use the words conventional and FHA. They have their pros and cons, and, conventional typically has a slightly higher interest rate, but lower mortgage insurance. FHA has typically, the slightly better interest rate, but higher mortgage insurance, and that insurance is perpetual. We have other podcasts on that. We could talk more about it, but each buyer or potential first-time home buyer, I would vet you in terms of which program makes the most sense for you and why, and then present options. And if you qualify for both, then we talk through which one may make the most sense for you.
Yeah, and I think at the top of this, you brought up a really interesting point, which is maybe you have all the money, but it is all your money, and you don't want to spend all of that. Again, this is not financial advice, but Dave and I are both big proponents of having an emergency fund in the bank, not being tapped out on day one of home ownership. And so, if one loan gives you the ability to be completely tapped out, and that's it. If a pipe breaks tomorrow, you're done, game over.
Yeah.
You're putting it on the credit card. Or you could do a little work, jump through a few more hoops, get this 3% down payment assistance, and keep your 15 grand in the bank as an emergency fund. That goes a long way in terms of security and safety and options for you and your family. So it's not always that you don't have the money. It might just be, I don't want to use all my money. And this is a smarter financial decision. And that's the type of nuanced, advice that we can give you. And then those decisions ultimately are above our pay grade. You make your own choices, but we've at least given you the options so you can choose what's right for your family.
Right. You bring up a really good point, Rich. And I've just recently done one where folks, they saved enough money. And we did the down payment assistance program because they had, I think it was about $8,000 in credit card debt that, they're making minimum monthly payments. Once you buy a home, it's going to be harder to chip away at that. Well, you have enough money to pay off the credit card or buy a house, one of the two. But if you do the down payment assistance program, you're borrowing that extra 3% at 1% interest rate versus your credit cards that might be at 19 plus. So, and I'm always a fan, well, if I use that money, you could pay down your credit cards. If, something happened, you could use your credit cards for an emergency now, but you've paid those down. So we talk through all these, options for you.
Yeah. Awesome. Anything else we need to know about CalHO? Let's tell them about the education requirements and some of those hoops they have to jump through.
Yes. Great point.
That we haven't mentioned.
Yeah, each one of these programs, they require a home buyer education. So there's a online course that you must take, and they say it's an 8-hour course. I don't believe it doesn't take 8 hours, but there's that really just kind of vets, make sure you've making the right decision for yourself. And it's not some realtor or lender that's telling you, hey, yeah, now's the time to buy. It makes you consider some things maybe, you haven't heard or discussed yet. And then there's also a live component of that where you spend up to an hour with a counselor. This is where we would provide them with a copy of your estimated closing statement or the closing disclosure, and that happens towards the end. And then you get a certificate that you've gone through the course. And it's a $99 course. That's what you pay for. You pay it on a credit card typically, but it's a requirement of the down payment assistance program that we're referring to.
Yeah, and I think sometimes people get frustrated with that. Or I always warn my clients, in the last 10 days of your real estate transaction, the lender Dave is going to call and ask for a bunch of random little thing. Can you send me a letter to explain why you took $2,000 out of this account and moved it to this account? Or we just went like 2 days long and now we need another bank statement because you've ticked over another pay cycle. And people tend to get a little frustrated with that. Or why do I have to talk to this counselor? But it's valuable to frame that in terms of, this is the small price I'm paying to let someone loan me 15 grand at 1%, right? So yeah, I got to do this 8-hour online course and spend an hour on the phone with a counselor. Would you do that for 15 grand at 1%? I would. Absolutely. Yeah, I got to cough up another pay stub, and I got to do it and scan it in and send over. It's a pain in the butt, but someone's loaning you 400 grand to buy a house, right? If you were loaning someone 400 grand, probably be reasonable to ask for another pay stub. So I know some of these things can sound like kind of a pain in the butt, but when you frame them in terms of the incredible value you're getting on the other side of jumping through those hoops, they almost always pencil out to be wildly worth it in the end.
Right. And you bring up a good point, Rich. And, when we work together, and part of this process is not making this in the last 5 or 10 days, this crazy fire drill for you as the buyer. If I know you're going to be part of the first time home buyer program, I'll send you the link, have you sign up and start that early. Because there could be some lag time here. And the last thing you want is a holdup at the 11th hour because you can't get a live counselor in order to get your certificate. So these are things that I'm versed with. And Rich, you mentioned it earlier. There's might be, uh, is unlimited little types of programs out there through maybe credit unions or one-offs. Impossible for us to be well versed in those, but the ones that
Yeah.
we are versed with, we know them quite well, and we're prepared going in, and we can answer the questions of the consumer and make it a stress-free process.
Yeah, and having that is one of the things where working with people who and this applies not just to me and Dave. You could be watching from Boston, Massachusetts right now. If you are, welcome. I was born there. But find somebody in your market who's been doing this a long time, because at the end of the day, what Dave is and what I am are professional problem solvers. And it's way easier to be a professional problem preventer than a problem solver. And so we've been doing this so long. Most of the conversations we have at the beginning of a transaction are about all the problems we see coming up with this particular buyer or home and how we're going to get out ahead of them now, so we don't have to deal with 11th hour stuff. That's not to say it won't happen. 11th hour stuff happens. It's just part of the business. But if you're working with someone who's been doing this a long time, they can really shepherd you through and spot these things coming a long way ahead. It's a lot easier to miss a problem if you spot it early. And that's a huge part of the value that having an experienced team brings to the table for you guys. So in terms of being an informed home buyer, one of the most important things is, if your cousin just got their real estate license 2 months ago, that might not be your best choice for your biggest financial transaction. You might want to call someone experienced and have him give your cousin a referral fee so he gets a little cut. You're honoring and helping his business, but you're also getting the experience that you need to get you through this thing in a way where it doesn't blow up in your face.
Right. And I think, Rich, you bring up a really good point there. And I know we've been on these scenarios. You've been in this scenario as a listing agent and as a buyer's agent, is the knowledge of what the buyers are doing, what they're presenting. Why are they asking for a seller credit? Why are they doing a down payment assistance program? And it really just comes down to communication and who's on the other end. And I know you and I have talked through this many times, where you've presented an offer, you've had a conversation with the listing agent. I've also contacted the listing agent on behalf of, if we have joint buyers, and really just talk through, why do they need a seller credit? Why are they doing a down payment assistance program? And once they get that, listing agent gets a comfort level, oh, this makes perfect sense, because they've all been in our shoes. And we want to make sure we're giving the buyer the best ability to purchase that home, where if you're not working with a seasoned agent like Rich, or you're working with your cousin who's been in the business for 2 months and submits an offer, you may not get that house because they may not be able to talk the language that Rich can talk to give that warm and fuzzy to the listing agent, who then translates that information to their home seller that says,
Yeah.
hey, I've been through this before. Rich knows what he's doing. The lender knows what he's doing. We're in great shape. This is as good as this conventional offer that might be $5,000 less. It's great. And you're helping out some folks that really love your home.
Yeah, and that's an important point that we didn't talk about when it comes to some of these things. Now, when it comes to gift funds, that is behind the scenes. Nobody knows you're getting gift funds. If you're pulling a loan from your 401k, nobody knows, right?
Right.
But if you're asking for a seller credit, or you're doing a down payment assistance program, we have to list on the contract what kind of loan you're getting. So if we send over an offer that looks like you're putting no money down, you're getting down payment assistance, maybe you got down payment assistance and you asked the seller for a credit for the closing costs because you really are coming out of pocket with no money here. There is a bit of a stigma to that. As a seller, if you're selling your home, you want the most secure deal you can. So an all cash buyer is the most secure deal you can. They got all the money. And then they look at it, conventional loan, that's the second best. FHA loan, that's the next best. Then unfortunately, there has been some stigma. We'll talk about this another thing, to the VA loan. So VA loan, I consider it on par with an FHA loan now myself, because it's not nearly as hard as it used to be. And I wish it was at the top of the heap, because it should be the most benefit it could be for our veterans. But still, I think it's either on par with FHA or below. And then when you add a wrapper of down payment assistance onto that, it can give the other side the sense that, do I want to work with this buyer? They have no money and they could bail out. They might not qualify. And that's where not sending that offer in blind and just dropping in someone's inbox and letting them have their own perception comes in. The strategy Dave's talking about, where I get on the phone, he gets on the phone, lets them know they've got the money. They just wanted to keep more in the bank for an emergency fund, or here's why they just did this, or maybe they had some medical debt they had to pay off which took up their reserves. And so now they're doing it this way. If the story makes sense and we can make them feel secure that we've done our job to vet you, we can decrease the stigma associated with, or the detriment in the eyes of a seller associated with you coming in with what we call less skin in the game, less of your own cash. So that is a good, important point. It is important that you know that is associated with this. And we have tools, and whoever your representatives are should have tools to help minimize that perception in the marketplace.
Right. And I think these programs too are in this market, they've become more common. And, like you were talking about, Rich, in a COVID market and cash market, sellers probably didn't want to mess with some of this stuff, but have approached to what we call more of a normal leaning market. And so, from a seller, they want to maximize their sales price. And if it's been communicated to them and they're getting $510,000 for a first-time home buyer versus $495,000 from a cash buyer, well, big difference to the seller. If they're confident in everyone's ability to perform, why walk away from 15,000?
Yeah, exactly right. And so, yeah, it is a nuanced thing, but there are tools we can use to help, make that pitch to the seller why you, even with down payment assistance, are the best buyer to win this property. I think let's address VA before we go. We have one more sort of niche case one you were going to talk about, but VA isn't actually down payment assistance per se, and we'll do another whole podcast for you all on the VA loan. We do have one where we compare VA, FHA, and conventional. It's already on the channel. You can watch that, but coming up, we'll do a full VA one for you, but VA allows 0% down. So in that case, you're not getting down payment assistance, but you are able to borrow the full amount. Now, that is not like the Cal HFA, that is borrowed at the full interest rate you're getting. So that amount you're borrowing does contribute to your payment. So your payment would be higher going VA. So you might be a veteran, by the way, that decides, wait a second, can I do the Cal HFA? Because that's better, because I'm only paying 1% on that versus the VA, I'll be paying my full rate on that, right?
Right. Yeah, I'd say, but to that point, Rich, if you can do VA, the other, besides zero money down, and you can be a veteran and put money down, you're not required to do 100% financing, but there's no mortgage insurance. And that's really the kicker. For VA,
and if you're, sorry, go on.
I was going to say, for a VA, a veteran that's, has the ability to go with a VA loan, there is what's called a funding fee, which can be built into the loan. So there is a higher cost. And FHA has its own mortgage insurance premium, which is a separate conversation. So there are some additional costs for those two programs. But when you eliminate mortgage insurance, it almost always makes sense to go VA if you can, and if the home will qualify for a VA purchase.
Yeah. Two old guys who've been doing this too long. That was what I was going to address, was the funding fee. Actually, but the other thing about the funding fee, though, is, of course, if you're a 100% disabled veteran, they waive the funding fee. And so there's other ways to, for our disabled veterans to get around some of that too. Is that correct? They're still waiving that?
Yep. And your certificate of eligibility will state whether you're funding fee exempt. And, usually when I'm talking to a veteran, they're keenly aware that they are funding fee exempt, and, they have these benefits. They want to take advantage of them if they can.
Absolutely.
And they deserve to. They've earned it. So.
Yeah, absolutely. So in this landscape, is it down payment assistance? No, but if we're talking about, I've only saved up 3%, or I haven't saved up enough and I want to pull the trigger and buy a home sooner, what's a way to do that? Well, if you're a veteran, the VA loan is another great avenue for being able to purchase a home with less than that total of 6% down that you need for down payment and closing costs. You can also, by the way, as a veteran, get up to a 4% credit to closing costs. So if you got your closing costs are about 3%. So if you got a 3% credit from the seller while doing a 0% down VA loan, you're a zero cash out of pocket borrower on that transaction, which is a huge benefit to you.
Right.
I just wanted to get, one more.
Yeah. And I think one other thing I should note, when we do the My Home program, whether you're going conventional or FHA on the first and you're borrowing the money, there is a fee for that. It's typically an extra point on average. So instead of a 3%, it's oftentimes closer to 3.5% to 4% in closing costs if you go with that program. So I just wanted to throw that out there, that there's a little bit of a cost to that. But again, when you're borrowing it at 1%, it gets absorbed pretty quickly.
And that would be akin on anything up to like a $750,000 home. That'd be akin to the VA funding fee, essentially, because the funding fee right now is about 7,500 these days.
That is correct. Yeah, 1%. You're looking at, yeah. So
Yeah. So I mean, if you're $500,000 house, your
yeah,
fee on the My Home is five grand, and if you're 750, your fees
yeah,
7,500. So you
right,
can kind of think of that as similar to paying the funding fee.
right. Yep. And so, in that situation where you just might need an extra 1%, and if you're going FHA, we certainly have enough in seller credits or whatnot. But just as a rule, be prepared. Might need 1% of your own money, and if you're buying a home, not too much to ask to make sure that you're coming to the table with 1%.
Yeah,
Um,
absolutely.
Yeah, and that 1% too is, one of the things we talk about is you need to leave an earnest money deposit when you purchase a home. And, I don't want to get in the weeds here, but, you buy a $500,000 house and, let's just say you're leaving, $3,000 as earnest money. You write a check to the title company. That money goes towards your closing cost and or your down payment. And if you have a seller credit or you're doing the My Home and you have home buyer assistance, those monies can actually come back to you.
Oh,
If
correct.
you
Yeah.
if everything's being covered and you end up at 100% financing plus closing costs, you might even get your 3,000 back or a
Yeah.
portion of that. Yeah.
Yeah, absolutely. Or vice versa. If you're coming out of pocket for that 1% fee,
Yep.
that could be attributed to that 1%. So it's typical in our market to do
Yep.
between 1% and 3% for
Yep.
your earnest money. So you might already have on deposit within 3 days of the contract going in enough to cover that fee. So
Yep.
yeah, it's a good point. The final sort of much harder to get an access program. So we're not going to spend a lot of time on it because it really is a benefit to very, very few. In fact, I think you did one recently, Dave, and it's the only one I've personally
Yeah.
interacted with that got this benefit. But we should mention it because people
Yeah.
know about it, and I think people hear about it and think, "Oh man, I got to go for
Yeah.
that." But we do want to make it clear how challenging it is.
Yeah, and this is the Dream for All program, and I'll tell you, shoot, it goes back almost 2 years now, where they launched this program with no necessarily. So it was, government funded. There was a pool of funds that was designed for home buyers to be able to take advantage of up to 20% for combination of down payment and or closing costs. So you could borrow, you didn't have to use it all, but you could use up to 20% with what they call an equity share program where you're participating. So if your house were to appreciate by 20%, you borrowed all 20%. When you go to sell or refinance, you're giving up 20% of that money that you borrowed. So, that percentage in terms of the equity share, which is still amazing because typically when you're getting 20% down, you're avoiding mortgage insurance. Your payment's going to be much lower because you're putting so much more money down. So, doing the back of the napkin math is you're avoiding mortgage insurance, but you're giving up a little percentage of your gains. Everything I kind of penciled out, it was well worth it. Now the caveat to this, so this was launched and there was a limited amount of funds, and the program just got bombarded by people that wanted to take advantage of the program. Well, they ran out of money very quickly, and I wasn't aware of maybe one or two folks that even, through talking to people that were able to participate in the program. Then they rolled it out again. I think it's been probably 6 months ago now, close to it, and it became a lottery process where you get pre-approved by your lender, such as myself. You submit an application, and that you get a response back of whether you've qualified, you're going to get a voucher, or you're on the waiting list. And, I'm working with some folks that were on the waiting list, and they were on the waiting list for 4 months, and their number just came up. And then when your number comes up, you have like 90 days to close a purchase.
Oh man.
So it becomes quite of a stressful thing, but it's an amazing program. But you also have, if you're buying it with yourself or a spouse, at least one, or a significant other, one of you needs to be a first generation home buyer. Both of you need to be first time home buyers, which means you haven't owned a home in the last 3 years. And one of you, or if you're just buying it individually, have to be a first generation home buyer. That means your parents do not and have not owned a home.
Yeah.
So
Are there income requirements as well that you have to be
There
below
are
an
some
income threshold?
income limitations there, and there's there's not. It's a little bit different than the My Home, but so few people that I've come across really have an opportunity to participate in this program. It's kind of one of those things where if it looks like you meet the profile, you submit an application, you see if you qualify, but don't hold your breath.
Yeah, makes sense.
I think it's kind of a long shot deal. And some folks that, I've worked with folks that like that was their only option, at least in the short term. So it was worth it for them to, submit this, and knock on wood, they were able to participate in the program.
Nice. And now, just so the details don't get muddied up, what this is they are going to give you 20% for your down payment. And you don't have to, obviously, you're not making payments on that. It's not a loan. It's like gift funds. It essentially works like gift funds. And you are not paying that 20,000 back at closing. You're paying a 20%. Back that up. They're going to give you 20% down. And so on this scenario, when we're talking about our $500,000 house, they're going to give you that cash. And then when you sell that house, you're going to give them 20% of the profit. But only 20% of the gains, or 20% of everything?
Of the gains.
Okay.
And there's some fine print in the program that, we don't want to, like we said, muddy this too much. But in our scenario, $500,000 purchase price, 20% down is $100,000. You buy that house for $500,000, you put the 20% down, you sell it, and I'll just use round numbers, 3 years from now for $600,000. Well, they're going to take 20% of that $100,000 profit. So there's 20,000. So you made 80,000, you're giving up 20,000, but that's 20,000 that you wouldn't have made because you wouldn't have had an opportunity to buy that home anyway.
Yeah. But and then the original 100,000 though, is that levied as like essentially part of your loan? So they get made whole, they get paid back off the original 100,000
plus their profit. Yes.
Plus their
the
profit.
20%.
Yeah.
Yep.
So in the end, in that scenario, if your home went up by 100 grand, you gave up 20,000 in profits for the benefit of having had the 100 grand to buy the house.
Right. That is
correct. Not too bad. Again, we want to be clear. This is, so far I know of one person who's gotten it. So this is, the My Home with Cal HFA is sort of all day long bread and butter. I think we did 2 or 3 of those together, just you and me together last year.
Yep.
I had one of those come in on one of my listings last year. These happen all the time, and the Dream for All is a very sort of niche case, tends to run out of money. We did actually recently have a freeze on all federal grant programs that some got frozen, some didn't, and that's still working its way out in terms of what the details are. So I don't even know if I would hang my hat on having another round of funding for this.
Sure. Yeah.
Given those things. So we'll look into it for you. Feel free to ask us or ask your trusted professional in your market. But again, like Dave said, don't hang your hat on that being the thing that's going to be your pathway to home ownership. Right. So to recap from the 30,000 foot view, we started with get some gift funds. Find a family member who's willing to give you some money, mom or dad, aunt or uncle, to help you get over the line of the amount of money you need cash to close to buy a home sooner rather than later. Or you can borrow from yourself in your 401k. We can ask for seller credit if you have at least 3% saved up on your own. If you're a veteran, you can access the VA loan to get 100% financing. We have the Cal HFA MyHome Program, which will cover your down payment for a lot of you. And then for a very few of you, there's the Dream for All. And there's even more like niche, crazy ones at credit unions all over the place that aren't worth covering here. But all this is to say, if you're on your path to home ownership and you're doing your due diligence and you're saving up and you're like, man, I'm just not there yet, but I'm watching the prices start to get out of reach, reach out. It doesn't cost you anything. There's no cost to get on a phone call with your local lender. Like I said, if you're in our market, give us a call and let's see if there's a program that helps you get there sooner, especially if you're in these rapidly appreciating markets.
Yeah. And I think you bring up a really good point, Rich, is that what it does is it speeds up your timelines. So instead of waiting a year and a half, and these are the types of things you consider, reach out to us. Maybe you're renting and you're getting ready to sign a 1-year lease. Well, guess what? You might not have to wait a year. You might be 6 months out or 3 months out to be able to qualify. So before you lock yourself into anything, let's have a conversation and have a game plan. And like I said, there's no cost to that. We spend a little bit of time with you. We figure it out. And if we're working with you in a month, great. If we're working with you in a year, great. Whatever's best for you and what your requirements and needs are.
Yeah, absolutely. I think we'll wrap it there, folks. Thank you so much. We are 44 minutes into here. If you stuck with us this long, you are deeply dedicated to your own financial education, or you're a glutton for punishment and like to listen to Dave and I prattle on. Either way, we are so happy you spent this time with us. Thank you for watching. We'll link to a couple other videos to explain some of the topics we touched on here at the end. And we look forward to seeing you guys on the next one. Dave, thanks for being here.
Thanks, Rich. Appreciate it.